The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks. This is Larry Pesavento for TFNN, and I'm going to start the show today with the chart that we put in here about a month and a half ago when Barron's came out and showed, the last time that it called for some major moves up in the stock market. And, of course, you can see they were talking about the Dow going to 16,000, and, of course, it got to 15,400, and then it had a correction. This pattern that we're looking at with those three drives to a top pattern over that 14-year period is the one that has made us so bearish since April, but in May, on May 25th, when we had the lunar eclipse and full moon, that was the one that was the most. Now, we have a lunar eclipse, we had a full moon yesterday that was also known as a super full moon. It's a moon that is perigee. That's where the Earth is as close to the moon. The Earth and moon are as close as it gets. It's 10,000 miles closer. And then when it pulls away, it moves to perigee. It moves in an elliptical orbit, of course, and goes to apogee, which is the Earth farthest away from the moon. Pythagoras had figured out these two phenomenons back in 600 BC, but unfortunately he couldn't get very many people to listen to him. So we thought we were on a flat Earth for many years until Columbus discovered America, and then also Galileo came in and a whole bunch of other people to prove that we live in a circular orbits or elliptical orbits, and our Earth is actually round. So the problem with the lunar cycle, folks, it only works for about 2 or 3 repetitions, and then it disappears for a repetition or 2, and then it comes back. It has a very high probability during the time that it's working. Now, if we made a high back on May the 25th, after the the full moon, it makes logical sense to me, since we've come down 5 straight days into this full moon that we have now. And this is a very, very bright moon. If you folks are in an area where it's clear, you should go in and go outside and look at it, because it's really a beautiful, very, very bright moon. The brightest moons, of course, will be the one that we have in September, which will be the harvest moon that is very big also. Now, we want to look back at I posted also into Tiger TV the last corrections that we had during 2010, 2011, 2012. They ran 2010, we had a 16% correction. In 2011, we had a 19% correction. 2012, we had a 10% correction. And we're approaching 10%, pretty close, but we're only doing it in a very, very short period of time. And that's telling us that this market wants to go a great deal lower, in my opinion. I feel very strongly about that. Most of you that have been listening to the show for quite some time know that I have been, very, very bearish that. And I would like to reiterate that I am extremely bearish. I think we're going to get some, moves that will, be against the trend for some time. And one could start today, because the market is basically oversold a bit. But that's what we're looking at, is something far, far sinister to the downside. Something that's going to be probably record-breaking would be my guess. That would be the thing that I would be watching. Now, I had a request to talk about Apple, because Apple, Friday we closed below the level that we wanted to look to be a buyer at it. And then, of course, today Apple gapped down, and it's now below the 786, would have been at 1401. So if you happen to buy Apple on Friday, that pattern has failed. It's just not working, and it looks like we're getting ready to make a three drive to a bottom pattern in Apple, somewhere around the $350 per share level. That will be not today or tomorrow, of course, but in the next 5 or 6 or 7 trading days, we could easily meet that, especially if the market, continues to go down to the the downside. Now, these patterns that we talk about here, folks, all of them are probabilities. There's not one of them that is 100%. The closest thing that we have for as far as reaching percentage is that 5-point reverse wave pattern that we've been talking about in the Dow Jones and the NASDAQ and the London and Germany and every place else. I mean, they're everywhere, that particular pattern. That one has a better than 80% chance of winning. But Gartley's and butterflies, they're in the 70 to 75% chance of winning at the very most. So you're looking at patterns that are only going to work, equal percentage of time, around 70, 75%. That is an incredible edge, because no place in Las Vegas do they give you a game that you have a 75% chance at winning. The only game that you have a chance of 75%, well, actually it's 100% chance of winning in Las Vegas, and that's the losing game, because they build those casinos on losers. They don't build them on winners. So remember that these are all probability-based. You have to use money management, and you have to use some common sense and some mental discipline, because when these fail, they can go a great deal, to the downside. Just for example, with this Apple, failing the way it is would tell us that we would be looking at a price of approximately, let me just do that because you'll be able to see the three-drive pattern that would form over the last 4 or 5 months, and you'll get an idea that this pattern will be, my goodness, you're right, it comes down to all the way down to the $350 per share level is where it looks like Apple wants to go, and that's another 10% from where it is now. And that doesn't mean that it's going to hold at 355. It could be a 1.27 or 1.618 expansion. I was listening to Basil's show before we came on, and he talked about his bearishness, and I certainly couldn't agree with him more. The VIX index has been telegraphing, that we've had something really sinister, going on in these markets for quite some time, and it looks like that's what is happening. And I think that before long we're going to see a situation of where the VIX is going to get to that level that he talked about, and that was the $38 level in the VIX. And we will first take a look at it on the daily basis, and then we will look at it on the basis for the long-term weekly. But first we'll look at it as soon as I get the chart lined up so that we can see it nice and clear, and we can see the three-drive. Oh, dear, hold on one second. When you try to teach an Italian to walk and chew gum at the same time, that makes it a little different. So I'm of the camp that we are getting ready for a counter-trend rally here. The market is very oversold, and I think that we will get some type of rally. Whether it starts today or not, I'm not sure. The VIX is telling me that it's probably going to start today, because we made a higher high than we did on last Thursday, and now we're, drifting down, which is a good thing. And then we should have a pretty good chance of a sell-off. And any sell-off should be, held by good support in the VIX at around 1490, to around 15, somewhere in that ballpark, is what I would be expecting to have happen with the VIX as far as your overall. Oh my goodness, I'm just looking at this NASDAQ, and you talk about a falling safe. This thing has really had a really big correction here, and we have made a big Gartley pattern now in the NASDAQ that has completed at the 786, I believe. Yep, just about exactly at the 786, and we should be getting ready to have a boy, I'm having a slight computer problem here, and I'll post that one into the room, and you'll be able to see it also. But this is telling me also that we have a chance of a rally back in stocks either today or tomorrow. I don't think it'll last very long. Somewhere, usually these lunar cycles last from 3 to 5 days. But the main thing you want to remember is to get your house in order on being out of stocks for the long term, because we've made a major high here, folks. It's really starting to look a little nasty, and when you look at where things are around the world, it has to, open your eyes to tell you that there's something, really, really sinister, out there that, doesn't look well at all. We've mentioned several times over the past, that China was supposed to be the one, to bail us out of this quagmire that we're in. And I wanted to post the Chinese market to show you, what dire straits they are in, because here's a market that was supposed to take us out of the doldrums of our recession and put it in full employment and stuff. And as you can see, since 2007, the Shanghai market, excuse me, one second. The Chinese market has been making lower tops and lower bottoms, so it is on its way down. I think we're going to test the 2009 low in the Shanghai market without too much trouble, probably sometime in the next 4 or 5 weeks would be my guess. 4 or 5 weeks or months, it should get down there. It looks absolutely terrible, and that's something that's very important. Now we have something. I'm going to have to break this up in 2 sections because I know we have a break coming here pretty quickly. But we had some really great news on the gold that'll give us some really strong indication of where it's going to go. Our good friend Mr. Z in the Tiger Trading Den forwarded me an email over the weekend because I'd asked him to do some research, and he is a top-quality researcher. And then after I got it, I verified it with someone else, and that is that the open interest that we have happening in gold is incredibly bearish, folks. Let me tell you what's happened. We've lost 25% of the open interest in gold since the last $150 down move in gold. In other words, people are just leaving the markets in drove. And that's not a good sign because that means there's very few players being left. When you couple that with the fact that the CME has raised the margin from $7,500 to $10,000, increased margin by 25% when a market that's going down, that's almost unheard of. They almost never do that. They usually reduce the margins when people goes down to get people interested in investing in the thing, but they didn't do that. They reversed it. And I think this next statement that John brought to our attention is the one that's the most important that might be tied to the two others, and that is that the COMEX exchange has put a disclaimer out that's saying that they have no responsibility to the numbers that are being published by these people that have ETFs for the gold products, particularly GLD. They're saying that just because they say they have X number of things in the warehouse or on deposit, that doesn't necessarily mean that that's so, because these have not been verified. That's very important, folks. 877-927-6648.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX. The Art of Timing the Trade charts has officially launched at TFNN. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind software, The Art of Timing the Trade charts allows you to scan for Fibonacci formation setups, including Gartley's, butterflies, ABCs, and much more. The Art of Timing the Trade charts is designed to help you when scouring the market for stocks just beginning to form the trading patterns that many investors spend days, weeks, and even months searching to find. As part of our introductory pricing, we're offering licenses available at only $59 per month. We're so confident that you'll love this new outstanding piece of charting software that we'll even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Lock in your low price today by ordering your copy at TFNN.com.
Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, we're back, folks. And we were discussing the state of the gold market, and I posted into Tiger TV the picture of the gold market on a long-term daily basis, and we have a small amount of support down there at that 1265 level. That was a 1.27 expansion of the last swing down, and that doesn't look like it wants to hold because, you know, we can only rally up to about 1299. In other words, we rallied $37, you know, off of the bottom, and now we're giving most of that back. And silver is, also, getting hit pretty badly. It's down another 54 cents per ounce today, and that's not a good sign. But the one that I think is the most damaging is the long-term gold and silver weekly index, because that one should have held at the 786. That's when we made the first bottom in gold around 1565, and I really thought at that spot gold had a chance to hold up. But once we broke below 1565, there was no way you could really be bullish on the gold anymore. And now, this XAU, the gold and silver index, is really, pointing to taking out the lows from 2008. It's been very bearish, since, December of 2010, but now it is, starting to accelerate to the downside, and that's, not a very good sign if you're trying to, find a good way to hedge yourself against inflation. And therein lies the $64 question: are we really going to have any inflation if we have gold and silver falling the way that it is? Crude oil has already broken down below the 97.50 level, where it looked like it was going to be a breakout to the upside, and we talked about that it couldn't get below 97 if it was going to be a valid breakout. And as soon as it went below 97, it broke, and we've got silver going down, we've got the gold going down. So all of these are telling us that there's a strong possibility here that deflation might be the culprit here. The biggest surprise that I'm finding today of all the charts that I'm watching is the Treasury bond chart, because that market is under a great deal of pressure. It's made. There's no question that it's made the major top for the decade. That was made in October of 2012. July of 2012, and now we're taking out the lows of last year. In other words, interest rates are going higher than they were last year. That's the first time we've done that in a very, very long time. So interest rates are hitting higher, and they're doing it right in the face of the Federal Reserve, because the Federal Reserve continues to lend money to J.P. Morgan and banks, Goldman Sachs and Morgan Stanley, HSBC, Deutsche Bank. They're still lending money at 0.25%. They can go to the window and get that, and they turn around and lend it to their preferred customers anywhere between 5 and 13%. So that's how the banks are getting fat off of that. But pretty soon the Fed's going to have to protect their backside, and they're not going to be able to keep rates down at an artificial level for very long. That's what this whole experiment with QE1 and QE2 and QE3 was about, is that if they kept interest rates down, it would inflate asset prices, and people would feel better about wealth, and then they would hire people and businesses would go, and that has not happened. There's more people dropping out of the labor force than there are joining it, and that's another very, very bad sign. So this is something that I think is something that might be the black swan event that's out there, that this interest rates are going to go substantially higher, and that's going to pull stock prices down with it, as people realize that there's really not any safe haven by any stretch of the imagination. There never has been. It's just that the perception that Treasury bonds were a safe haven was there, but that's really all it was a perception. Just paper, just like anything else, and they've been printing so much of it that it's pretty hard, to realize why anybody would want it. I've said many times over the past year or so why anybody would lend money out at for 30 years, at 2.3%, is by far the biggest mystery to me. I just don't understand how anybody could do that. And yes, that is what the government has been doing to people. They've been doing it to the Japanese. They've been doing it to the Chinese. They've been doing it to us. And if we eat it, it's just that's just our fault. There's a thing in the Wall Street, the movie with Gordon Gekko, and he says the reason why it wasn't the Gordon Gekko, it was the American president, and he said the reason why people will eat sand if they're hungry is because they don't know the difference. So no one has told them. Anyway, we've got to take a little break here. 877-927-6648.
Tom O'Brien's daily newsletter, Market Insights, gives you Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. With Market Insights, nothing is left to guessing. With the market at record levels, volatility is here, and now is a perfect time to take advantage of a 2-week free trial to Tom O'Brien's daily newsletter, Market Insights. As recently as March 26th, Tom advised his subscribers to liquidate their 4 short short-term equity holdings, closing out all 4 positions for a combined 15.9% profit. And on April 1st, Tom advised his clients to sell their longer-term position in AIG warrants, locking in more than a 40% profit in just that one trade. If you'd like to see the kind of newsletter Tom O'Brien sends out to his subscribers each morning, then sign up for your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN. No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and I've posted into Tiger TV a chart from one of our good friends over in Hong Kong, Casey. He's an excellent trader and technician. He was kind enough to share the Hang Seng Index chart and put the patterns on it. And you can see that it's been in a bear market. This just goes over the last several years, but it shows that the Hang Seng has been in a bear market also, along with the Chinese. But the Chinese market is far more bearish than the Hong Kong market. There's just there's just a really big difference. I know China is has control over Hong Kong to some extent, but believe me, that's like night and day over there. Hong Kong is a very free place to live, and really fun place to go. And even though China is beautiful and it's got some wonderful places, there's some periods in there you don't want to be. In China, especially in certain parts of slum areas that they're quite scary. And we'll I don't even want to go into that, but that's like any big country that has a lot of poor people. You're going to have that happen. Now, the next chart that we want to talk about, I've actually had two people over the weekend ask me to expound on this, and that is that copper chart that we have showing the divergence between the stock market, which is the S&P 500, and what we have in copper. And for the past year, it started actually in September of last year. The divergence really started to get, very bad. It was already bad in 2012, but in 2011, but in late 2012, around September, the divergence really became bad. In other words, copper started making lower highs and breaking down badly, and we've gone from we've dropped over 33% in the value of copper, in the last 12 months, as stocks have rallied almost that much. So that divergence is an outlier event. We've never seen anything that way, where one market went up, the other market went down, and they're supposed to be related, to the economy and building profit and building products. And believe me, you can't hardly build anything in the building industry or electronics without copper. It's just automobiles, electronics, buildings, everything, anything related to electricity. All that stuff has to have copper, computers, and yet there's this giant surplus of copper because nobody is using it enough to to make up for the surplus. And I've heard the rumor, not rumors, but the arguments that, well, there's more copper available. That's not so. There's more copper available than the stockpiles because they're not selling it. But as far as the amount of production of copper, it hasn't been that much. All you have to do is to go look at Freeport-McMoRan and some of the others, and you'll see that that's the case, that we're looking at really some really tremendously what we call divergences, like nothing we've ever seen before. I wanted to bring out the euro because we talked about that. Before I do that, I have to show you something that I think is important because of where we are in the gold and also in the silver. If you look at the gold chart, I posted the chart since last September, and it shows the equal moves that we've had in gold on the way up. And, we basically, since that 61% retracement up at $1,783 a barrel, an ounce, I still think of it as black gold, as it at $1,785 a barrel, which was the 61% retracement coming off the high that we had in 1932. We've had these moves down, and once we went below 1565, that's when the market really started to accelerate to the downside, and we're still accelerating. We have a potential here since April 15th of a possible 3 drive to a bottom, but we must hold the 1262 level, and the way that the market is acting, it doesn't want to hold above that 1262 per ounce level in gold. And below that, believe me, there's very little there that will give much of a price relief, because there's just not much there between $12.62 and $100, per and $1,000 per ounce. Now, I also wanted to review silver because we're trading at around $19.50 in silver per ounce, and we could still drop another $2 per ounce, which is $10,000, and that would be the 786 retracement of the whole move from 2008. So there's still, that looks like where silver wants to go is another $2 an ounce lower, and that would pull the gold down another $150 an ounce without too much trouble getting it near that old magical level of $1,000 per ounce. Who would have thought that back in August of last year, when gold was trading at $1,900 and change, that it would be trading at nearly half that value just a year and a half later? Well, that's because, markets go up and markets go down, and, the buyers and the sellers become different fellers, and that's what the problem is. With open interest dropping like we're having in gold, open interest dropping, around 25%, that tells us that people are leaving the gold market. They're losing interest, both longs and shorts. And that means that, it's not a very good thing. And then when you stop and, realize that the Merc has increased margins by 25% from $7,500 to $10,000. And then also the fact that, we have this information about, COMEX making a disclaimer. Whether that means anything or not, I don't know. But I did see the disclaimer, and they did, in fact, say that they did not want to be responsible for the numbers that were be reported by these, people that have the ETFs. And that's just common sense. I would not want to say that I was the one that, said that there's X number of dollars in gold anywhere. We don't know if there's any gold in Fort Knox or not because no one's allowed to go inside to see it anymore. Who knows? All I know is I just follow the charts. If there's more buyers, there's prices are going up. If there's more sellers, prices are going down. And that's the bottom line of what we're looking at here. Now, the next one we want to look at was something that we focused on last week in the newsletter, and that was the potential in the euro, because we had that Gartley form on the weekly basis, and we went up to that 134 level. We got as high as 134.14, and we've dropped well over $3,000 in just a matter of 3 trading days. And so that's an indication that this is a very bearish chart. If you get a chance, folks, and take a look at the euro going back to 2008, that, we've been in downtrend all along. Each of the highs, 2009, 2011, 2012, 2013, they've all been lower highs. So the trend has certainly, been to the downside, and that gives us a price objective, well below 115 in the euro, and we're trading at 130 right now. Remember when the euro came out in 99, I believe it was priced at 130, and it went from 130 to 60, 130 to 160. Then it went from 160 down to 85, and then 85 back to 160. So it has some really wild swings, but this one is pointing to the downside as near as we can possibly tell. And if we can get the dollar index above the 85 level, then that would be a situation that the dollar would be breaking out to the downside, and that would make it a whole lot easier to be an owner of a dollar, because right now it's in a double top between 85 and the low that we made down at the 80 level. Now, I needed to talk just a little bit about the Japanese yen versus the U.S. dollar, because that's in play almost every day now. Everybody's talking about it because of the Nikkei futures have been hit so badly after hitting the 786 retracement up there at 16,000. And the Japanese yen just made last week, we talked about this. It made a 38% retracement at that 93.7 to the dollar, and we've had a pretty good rally of about $4,000 in 5 days, and so now we have a trading range set up here in the Japanese yen versus the dollar at 103 on the upside and 93 on the downside. So it'll probably be making some other patterns in between these levels over the next few days, but it'll be related to this volatility that we have going on right now. I wanted to spend a little time here because we're running out of time so quickly. I'm of the opinion that and I believe what I heard Basil say also is that I really think that we've got a chance here for the market to have a bounce. We're down 5 days, very strong into the some major support. The Nasdaq hit the 786. The S&P went just a little below the 786. So we're down in this support area. And remember, the shorts in the past have been scared to death because every time the market rallied, during the April and May, it had 22 straight days where it made higher highs or higher lows. It had 22 straight Tuesdays that it was up. That had never happened before. So the shorts would get scared again if we do have a pretty good rally into effect. But that's the one that you want to be ready to sell, because that is a short covering rally, and then the market will proceed to go down in stocks. The longer term picture that we have in the stock market is so incredibly bearish that I've called it the the mother of all tops, because it's something that you don't see very often, especially when you're seeing it all across the globe in just about everything. It really makes you appreciate the fact that I'll put it up here, because this is when we were still trading above 15,000 in the Dow Jones. We had this pattern known as the 5-point reverse wave. We have 1, 2, 3, 4, 5, and it forms a 3-drive to a pattern, a 3-drive to a top pattern. And the price level, I know you're not going to believe this, but there's a very high probability that we're going to go below the October lows, the March lows of 2009. It's not going to happen overnight. It's going to take several years. But by gosh, I think it's going to, it's got a chance to take out that 6,400 in the Dow, on a long-term basis. Okay, I have a request here to bring up corn, because we were talking about corn last week, the fact that it acted so nicely. We'll put we'll put the daily chart up, and we will take a look at that, and then we will take a look at the shorter term, because we've had a pretty good sell-off here, and we will bring this up here. This is the long-term pattern that we're looking at down at 525. We rallied well over $2,000 a contract, and now we're pulling back to an exact 61% retracement today. We've had some drying weather across the Midwest, and if you get a chance, you will get a chance to go into Tiger TV. You'll see that we are making that 61% retracement down here at the 543 level, and it would give us another chance to enter and not risk very much, because after the big move that we had, taking out the previous week's high, that was the place to take your profits. We talked about that you really needed to lighten up, because all we were doing was we were comparing what happened in 2012 to what's happening now. The market bottomed on June 14th of last year. This year it bottomed on June 17th. It had a very strong move, just like we did in 2012. Then it backed off for 3 days, and that's exactly what's happening now. So we're just looking at repetition. That's all it is. It's like I think Thomas Edison said, repetition is the mother of knowledge. And we'll see if it's going to be the case in corn, but at least that's how it started. Whether it's going to have much of a rally from here, nobody knows if that's going to be the case or not. The two things that I think that are the two things that are most surprising to me today, one is the fact that we're having such a big sell-off continuing down in the Treasury bond market. That market has been under a great deal of pressure for a long time now, and now we're starting to look like it wants to even go even farther to the downside. But we are so incredibly oversold in Treasury bonds that we're bound to get a little bit of a bounce. And today's low down at the 133.02 level, we've already rallied $1,000, was an exact 1.618 expansion of the last BC swing. And so that's what that should give us a bounce. We've also taken out the lows of March of 2012. So we've made new yearly lows in the bond market in just a matter of since May. It just literally has come unglued to the downside. So something's out there, folks. There's an outlier event. I don't know what it's going to be, but we're looking at higher interest rates coming in, and we're looking at lower prices in stocks. That's not good either. And now we're looking at a commercial. 877-927-6648.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and we've got a call from our friend in Palm Harbor, Florida. Jim, are you there?
Yes, I am, Larry. How's it going?
That's good. What can I do for you, my friend?
I had a buy to cover in this morning at 1668, and
1560. You mean 1568?
Yeah, they caught my stop, and I was running around. My neighbor cut the electric, so I was doing wireless trading, and I tried to short the breakdown of 60. And what happened was we had that little bounce to 65, so I had to stop to cover that. And what I'm trying to learn is to short the bounces rather than the breakdowns. And for a lot of people in the den like myself that might not be short enough or are flat right now, how do you control those urges to chase rather than sit back and wait for a counter-trend bounce?
Well, if you're not going to wait, you're going to have trouble, because if you use the right word, and that's an urge. And my grandma used to tell me, if you have an urge to trade on something you don't see, go down and lay on the couch until the urge goes away, because you have to have some things. And, you're talking about a very small bounce here, Jim, from 1558 or so up to 1565. That's only an 8-point bounce. I think we have the potential to have something like a 40 or 50% bounce, or 40 or 50-point bounce in the E-mini without any trouble at all. And I don't know when we're going to get it. Either come today, tomorrow, next week. I don't know, but we should get, a bounce somewhere in here. The market's not going to go straight down. It never has. Even though I'm incredibly bearish, I think we're going to get some pretty good rallies. And look for the ABCD formation. That's the one that's going to take you to the promised land. I mean, we watch those on the show all the time. Steve Rhodes does. I mean, even Basil does his counts very similar to that, and that also gives you those patterns. And those are the ones that you want to, sort of try to watch. But a small one like that, or 7 or 8 points, that's insignificant in this kind of market, especially when it's dropping, 200 Dow points a day.
Well, and then it also looks to me like we've had a little, now it looks like we've had a little head and shoulder bounce all the way at 1553. And so the bounce may have started. The only other question I would have is if there is something catastrophic or somebody runs stops, so whatever the case may be, would you put do you have a sell sitting underneath the market, like at a 1551 or 1550 worst case?
No, we have been short the market since May the 25th. We added again in June when we had the rally back right after Father's Day that happened last Thursday, and we covered everything today at 2 levels. We covered a third of it at 1572, and we recovered the rest of it at 1564 in the futures. That's what we did, and now we're waiting to see if we get a move going. We got out of the VIX index just a little above 20.5. And we're waiting to buy that back. And, and we might miss it. Maybe this thing's just going to melt down, Jim. I don't know. But, frankly, they give you a lot of chances to board the train. You just have to wait, buy the ticket, and sit there and be patient, my friend.
Right. Well, then I don't feel bad covering at 1568.
Yeah, we will get a pretty good rally. And if you don't want, just watch for a 382 rally. A 382 rally of the move would take you back into that 1600 level, and that's where the market broke down from. That was the high, at 1596 is where we were 2 particular days, back in early June, and we broke below that. So that would be normal resistance now if the market would get there. That's only, 35 points away from where it is now, so that could very easily do that. Listen, we got to end the show here, Jim. Thanks for calling in, my friend.
I will watch the counter trend bounce rather than the breakout.
I agree with that. Live every day in an attitude of gratitude, and may God bless.
Hi, folks. I'm Steve Rhodes with TFNN.com, and the trend is your friend until it changes. A free special report is now available on the homepage of TFNN.com, and if you have money in the markets, this free report is a must. If your strategy is buy and hold, this report is a must. If you're a day trader, a swing trader, a Forex or options trader, or just getting into the markets, this report is a must. And it's the second best gift you'll ever receive. Look, if you buy a stock and the general market is trending in the other direction, you've reduced your odds of buying at the right time by 70%. Instead, let me teach you how to get that 70% advantage plus. The plus is a free trial to my daily newsletter service, Mastering Probability. There's no upfront deposit, no charge to your credit card, and I compress decades of education into each daily newsletter. This is a limited time offer, so act now, and I'll teach you how to take the trend and turn it into your best friend. All the details are on the homepage of TFNN.com. Act now.